In the world of technology and finance, a select group of companies hold such immense power that their decisions can send ripples, sometimes even shockwaves, through the entire market. These are the titans whose influence extends far beyond their own walls, shaping the direction of industries and the fortunes of investors worldwide. Oracle is one of these giants. With a legacy that stretches back decades, it's a name synonymous with innovation, reliability, and scale in the tech world. For years, Oracle has been the backbone of countless businesses, governments, and organizations, providing the database software and cloud services that keep the digital world running smoothly. Its technology is woven into the fabric of modern commerce and public infrastructure. When Oracle makes a move, Wall Street pays close attention. The company's financial health is often seen as a bellwether for the broader tech sector, offering clues about the direction of innovation and investment. This week, Oracle did more than just make headlines. It sent a tremor through the stock market, especially in the high-flying artificial intelligence sector that has captured so much attention and capital. The company's latest earnings report fell short of Wall Street's lofty expectations. But what truly caught analysts off guard was Oracle's cautious outlook for the future and its announcement of aggressive spending plans to build out its AI infrastructure. Suddenly, the narrative of an unstoppable AI boom was thrown into question. If a tech leader like Oracle was signaling caution, what did that mean for the rest of the industry? The market's reaction was immediate and dramatic. In after-hours trading, Oracle's stock price plunged, erasing billions in market value and signaling a sharp shift in sentiment, from AI euphoria to a wave of skepticism and concern. Investors were forced to confront a sobering reality. Building the future of AI comes with immense costs, and the timeline for turning those investments into real profits is far from certain. The risks suddenly seemed much more tangible. This single earnings report didn't just impact Oracle. It made investors across the globe rethink the entire AI sector, questioning whether the rapid growth and sky-high valuations could really be sustained. Oracle's news triggered a chain reaction, sending shockwaves through its suppliers, business partners, and even its fiercest competitors. The entire tech ecosystem felt the impact. This week on Wall Street became a tale of two powerful forces: the fear sparked by Oracle's AI reality check, and the relief offered by the Federal Reserve's latest signals on interest rates and economic stability. Understanding this collision of tech uncertainty and macroeconomic reassurance is key to grasping where the market stands today and where it might be heading in the months to come. So, let's break down exactly what happened, why it matters for the future of AI, and what it could mean for investors and the entire technology landscape. When investors dive into an earnings report, they're searching for two key things: how the company performed recently and what the future might hold. These reports are more than just numbers. They're a window into a company's health and its prospects. For Oracle, this quarter brought disappointment on both fronts. The company not only missed Wall Street's expectations for revenue and profit, but also projected more weakness ahead, a clear signal that its business isn't expanding as quickly as many had hoped. This kind of outlook can rattle even the most patient shareholders. The real shock, however, came when Oracle revealed a dramatic surge in capital spending. The company is pouring billions into building out its tech infrastructure, especially to support its ambitious push into artificial intelligence. Lower profits combined with soaring expenses is a classic recipe for investor anxiety. Oracle's growing debt load and the uncertain timeline for any payoff from these investments raised serious red flags among analysts and investors alike. Many analysts described the report as lackluster, noting that Oracle failed to deliver the kind of growth story the market was hoping for. Still, there's a sense of cautious optimism about Oracle's long-term AI strategy. Some believe the company could eventually benefit from its partnership with OpenAI, but they also warn that Oracle is heavily dependent on this relationship for future growth. As a result, price targets for Oracle stock were trimmed by several major firms, reflecting a new wave of uncertainty about the company's near-term prospects. The market is now left wondering whether Oracle can actually turn its massive AI investments into real sustainable profits, and, crucially, how soon that might happen. Oracle's stumble hasn't just affected its own stock. It's also cast a shadow of doubt over the entire AI sector's growth story, making investors more cautious about other companies with similar ambitions. Now, investors and analysts alike are watching the market closely, looking for any signs that Oracle's troubles could signal a broader trend. or if this is just a temporary setback for one of tech's biggest players. For 2 years, AI has driven the stock market, with investors betting on a technological revolution. Oracle's report was a reality check, forcing investors to consider the true cost of building AI: massive data centers, powerful chips, and complex networks. The company's need for more spending, even as revenue growth slows, reminded everyone that AI profitability isn't guaranteed. If Oracle is struggling, what about the rest of the industry? Investors began to question whether sky-high AI stock prices are justified. The market is shifting from growth at any cost to a focus on financial fundamentals. Oracle's news may be the first sign that the gold rush phase of the AI boom is ending. Now, companies must prove they can actually make money from this costly technology. The AI sector faces a new era of scrutiny. The stock market is an ecosystem. When a giant like Oracle stumbles, the shockwaves spread fast. Oracle's disappointing report triggered a sell-off in other tech stocks, especially those tied to the AI supply chain. Investors feared that if Oracle slows spending, suppliers of chips, networking gear, and cloud services would feel the pain. Major players like Broadcom, Marvell, and TSMC saw their stocks fall in after-hours trading. The fear is contagion. If Oracle's struggles reflect a wider problem, the whole sector could be at risk. The market has shifted from rewarding AI ambition to demanding proof of profitability. Oracle's report forced a reassessment of risk across the tech sector. Now, every company in the AI ecosystem is under the microscope. Investors are bracing for more surprises. No group was watched more closely than the chip makers, especially NVIDIA and AMD. NVIDIA's GPUs are the backbone of the AI boom, and its stock has soared on the assumption that demand will keep rising. Oracle's report challenged that assumption. If AI spending is unsustainable, chip sales could slow. NVIDIA's stock dipped, reflecting new doubts about the longevity of the AI build-out. AMD, still catching up to NVIDIA, also saw its shares fall. The synchronized decline showed that concerns are about the entire AI economy, not just one company. Investors are now questioning how long the chip-buying frenzy can last without clear profits. The AI hardware boom faces its first real test. While Oracle's news rattled tech stocks and sent a wave of uncertainty through the market, investors everywhere braced for more turbulence. The sudden drop in confidence was visible on trading floors, as screens flashed red and anxious voices filled the air. In the midst of this volatility, the Federal Reserve stepped in to calm the market, acting as a stabilizing force when nerves were frayed. The Fed cut its key interest rate by 0.25%, a move that had been widely anticipated by analysts and traders alike, but still brought a sense of reassurance to those watching closely. Even though the cut was expected, it signaled that the central bank was ready to support the economy and respond to any signs of weakness, which helped restore some confidence among investors. Lower rates make borrowing cheaper for businesses and consumers, encouraging spending and investment. At the same time, stocks become more attractive compared to bonds, as yields on fixed income fall. Fed Chair Jerome Powell emphasized the central bank's commitment to supporting growth, making it clear that the Fed would act as needed to keep the economy on track. He suggested that inflation remains under control, allowing the Fed to focus on fostering economic expansion and job creation, rather than worrying about runaway prices. This dovish stance from the Fed was a welcome counterweight to Oracle's disappointing news, providing a sense of stability when it was needed most. The Fed's actions provided a broad tailwind for the market, lifting sentiment across sectors and giving investors a reason to hope for a rebound. Still, tech-specific fears lingered, especially among those closely tied to the sector's fortunes and the future of innovation. On one side, there's anxiety about AI's future and whether recent setbacks signal deeper challenges ahead for technology companies. On the other, optimism is fueled by easier money and the hope that lower rates will spark new growth and opportunity. The market is caught between fear and relief, with every headline and policy move tipping the balance one way or the other. Investors now face a crucial decision. Will the optimism from the Fed's support outweigh the worries about tech, or will uncertainty continue to dominate in the days ahead? The battle between company-specific worries and macroeconomic optimism is on, and the stakes couldn't be higher for portfolios everywhere. The outcome of this tug-of-war will shape the next market move, setting the tone for investors as they navigate an uncertain but opportunity-filled landscape. The Fed didn't just cut rates, it also announced it would start buying short-term government bonds. This injects cash into the financial system, boosting liquidity and making it easier for banks to lend. The goal is to reinforce the impact of the rate cut and keep markets calm. More liquidity means lower borrowing costs and more incentive to invest in stocks. The Fed's proactive approach signals it's committed to supporting the market. For investors, the message is clear. The Fed is on your side. Lower rates and bond buying make stocks more attractive than ever. While future cuts aren't guaranteed, the Fed's toolkit is wide open. The market is watching for what comes next. Oracle's disappointing report and the Fed's reassuring moves created a split in market sentiment. Before Oracle's news, stocks rallied on the Fed's rate cut and dovish tone. But after hours, Oracle's stock plunged, dragging tech futures down. The market is now in a tug-of-war. Bulls betting on Fed support, bears worried about cracks in the AI story. Bulls see the dip as a buying opportunity, trusting the Fed's safety net. Bears focus on slowing AI growth and unsustainable spending. For them, Oracle's report is a warning sign for the whole tech sector. This division sets the stage for volatility as investors decide which narrative will win. Will macro-level optimism or micro-level fear dominate? The answer will drive the next market move. All eyes are on the next trading session. With Oracle and the Fed behind them, investors are now focused on upcoming earnings reports for more clues. Broadcom's results will be key for the AI sector. Strong demand could calm nerves, but weakness could deepen the sell-off. Costco's report will offer a snapshot of consumer health. Strong sales would support the Fed's optimism, while weakness could add to market worries. Next week, Micron's earnings will provide insight into the memory chip market and the broader electronics supply chain. These reports will help determine if Oracle's stumble was an isolated event or the start of a bigger trend. Investors are watching for signs of resilience or more trouble ahead. The next chapter in the AI and market story is about to unfold.